Morning, everyone. Welcome. Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call. I'm Mark Gardner. Sorry about that. We had a little bit of technical issues there. But yeah, we've got a lot to get through this morning. We got chip stocks sinking after the Samsung results, which sort of set a negative tone straight away for the session. And look, people, ceasefire's done. Iran's attacked 3 ships overnight. And then there was a Bloomberg redhead, a big breaking story after the market shut that essentially the US has started strikes. So that is like ceasefire is dead. Memorandum of understanding is effectively dead at this point. And they had a Bloomberg defense analyst or geopolitics analyst on there, and he was very definitive in saying, yeah, this is done. So, I think there's some pretty good opportunities out there to play this in terms of what's going on at the moment with Trump's in Turkey. I don't know whether he's getting hair plugs or doing some geopolitical stuff, but there's been an announcement around NATO and them contributing to NATO, and then a lot of talk around NATO spending. A few contracts have come up in the last couple of days. So these defense stocks and a lot of these energy stocks are super, super cheap. As I mentioned in a lot of the previous podcasts, like the market's just pricing out any risk of this flaring up. And the track record of any form of Middle East ceasefire is basically 100% of it being broken. And if Israel's involved, which it nearly always is, I don't know whether you can get 110%, but it'd be damn close. So, but as you can see, there's a big rotation here at the moment, and we did see the likes of Meta, Microsoft, Nvidia rally still, and then your traditional healthcare sectors, and then the oil sector, because oil was up around about 5%. The market was shut when the US announced strikes. So at this point in time, I haven't seen an oil price recently since the reopen. But look, it was up around the 72 mark for WTI leading into it. And I think that there was the assumption. So I'm not entirely sure what we'll see over the course of the day if this escalates. We will kind of just see how it pans out, I guess. But overall, it's obviously not a very good thing. And we've got volatility at really low levels here at the moment. We've seen crude oil, WTI crude oil. I'm just double checking here. It's still really it's at 72.43. So it was up around about 5.5%. It's only really gone up another 0.5% since the reopen. So it's not. I guess everyone was kind of expecting it to flare up again at some stage. I still am of the opinion that you've got these oil companies, even with that rally last night, they've got fortress balance sheets. They've got 4 or 5 months now of elevated oil prices that they're enjoying that extra profit margin, etc. And they were kind of cheap anyway. Leading into this, and this talk of this oil glut just doesn't add up. Like it really does seem like Trump's almost ordering people to sell this story, because the amount of ships getting through Hormuz, the amount of barrels they're making up, and the amount of time it was closed, there is just no way. There's no way there's going to be a glut anytime in the next 2 to 3 months. And it goes completely against what all of those same analysts said, that it will take forever to unwind. So the big gap in the market at the moment is China's still got demand. It's still roughly around about half. But look, I mean, China's very good at doing these, and being patient and controlling itself in these situations, because they know if they come back into the market, it's just going to it'll scare the crap out of people, and prices will be elevated again. So, they've done this in many commodities, and it's the advantage of being a fairly centralized economy. But look, we've got, obviously you can see on the left-hand side, like Micron down 4, AMD down 6, Intel down 10, And look, Intel was probably my favorite for the one that pulls back the most. They have been they've been a repeat offender in terms of, horrible results, and sort of the chip sector's simple cousin that, and without government funding, would have probably been out. However, the new CEO is actually pretty good, and Elon being on board and bringing some of his engineering skills, and the new CEO of Intel admitting that, that they need help, I think is probably, I'm probably more positive on them than I have been in quite some time. But you're seeing sort of a drift back to safety, with Meta and Microsoft, and these got, the fairly cashed up hyperscalers, but it's not the same. It's not the same safety trade that, that we've seen in the past. It's because these guys have gone and issued an absolute crap load of debt. So, they're really not as safe as what they were in the past. You've got NASDAQ down, but look, I mean, we had SpaceX join the NASDAQ last night. For all that passive buying that everyone was talking about, it's only down 7%, and seems to be a little bit more like a falling rocket. Obviously, none of this news really was in the market yesterday, except for maybe the Samsung stuff for the Aussies. So not much massive effect. And I think we saw about a 39-point drop in the SPY futures overnight. A few of these technicals starting to deteriorate, but the Nasdaq, the Nasdaq was, the Nasdaq was down. The Nasdaq 100 was down, nearly 2% at one stage, and then the broader Nasdaq was only down that 1.16. Russell getting hit as well. Nikkei's kind of all over the shop. The Kospi was down 8% at one stage because Samsung was down 8%, and there's like 6 stocks that make up 60% of them. It's like the most concentrated index in the world. You're basically just trading SK Hynix and Samsung, realistically, particularly at these prices. But Samsung's earnings were they're pretty outstanding. It was like 19 times the previous year. But I think that's what people didn't like about it. The uplift was so extreme that everyone's like, there's no way this continues. And look, and then I think you're going to see a lot of the hyperscalers, if they're just buying this stuff and they're paying 19 times. Seriously, I think you're going to get analysts and investors just absolutely criticizing them, because they're not making anywhere near enough money to justify paying. And there's a race going on here for AI, but if you have a look at the people that are actually making money, like Anthropic, it's from a business standpoint, like the data centers aren't even built. There's power shortage and everything. I mean, at what point does it come? At what cost? So back to the defense thematic, as you can see here, we've got, you've got a lot of these NATO members shifting their percentage of GDP. So their NATO target's around about 2% of GDP. And as you can see, nearly everyone's there or above it. So that European defense thematic is something that we've been looking at for the last sort of 12 to 18 months. It's well, like I said, it's well through, and Trump was going, was applauding Turkey for actually doing more than what their supposed allies were, and he's been of the opinion that America doesn't have a stake. I think they were his exact words. We've got no skin in the game. We're not giving you money to keep fighting stupid wars, and fair call. I categorically think that this is what people elected Donald Trump to do, is stay the hell out of other people's business. That's why he put JD Vance in as vice president. The poor guys ended up having to drift into a bunch of geopolitical conflicts. So I think that those defense stocks have drifted back quite a bit, and I think they're quite decent buying here at the moment. And this is just another example of how unprepared, because of this chip stock rally, everyone's got a little bit complacent, and then the puts to calls. The downside puts to upside calls skew is basically means that around about 0.71 is about the lowest. So and then VIX is around about sort of the 16 mark, which is historically very low for the last 5 years. Essentially, that just means that people are bullish, and they don't have downside protection. And that's not a good thing. That's not a good thing. So and like basically what it says is that everyone's bullish and no one's got cover, and these sorts of setups are not good. And what I would say is it's that is very dangerous for this market moving forward. Particularly with the seasonality standpoint, and particularly with the midterm election coming up, and particularly with there being geopolitical risks. Oil prices are still high. We've got inflation. Like you've got a fairly hawkish Fed. Like, yeah, this, and realistically, the chip stocks, I think they've reached price elasticity breaking point, and judging by that market reaction yesterday for Samsung, and the market reaction last night, we've reached the threshold where you either look after your customers if you're a chip maker, or the people are going to find another way. I just stop buying. So that probably gets as good as it gets, and that's done 87% of the heavy lifting in all the indexes over the last, over the course of this year. So here's another area where, as well, like lithium, uranium, coal, obviously, and then crude. I think essentially with gold and silver. I mean, it's a weird trade, but I think yields were up a little bit last night. So essentially, that's just an interest rate trade at the moment, the precious metals. But look, these critical minerals, the rare earths, the lithiums, the cobalts, all of these critical minerals, and silver really should be categorized as one of those. It's essential in solar, and solar was actually went over 50%, or renewables went over 50% last year in terms of new energy infrastructure put in. So, and they need a lot of silver for that. So you can really, I think silver and copper particularly they're just long-term buying opportunities in terms of this energy transition, as are the likes of lithium, uranium, and rare earths, and obviously you want to be in those refining sectors more than those companies that are also refining. So Bitcoin took a bit of a slip, but I don't know, it's back to doing its own thing overall. We've got is Fed's meeting minutes tonight. That's going to be really closely watched. That's where those yields kind of slipped higher overnight. Everyone's a little bit concerned that Walsh is a bit more hawkish. He wants to get that balance sheet under control, which is categorically like the responsible thing to do. But that just means there's no QE, and like the whole extension of the PE ratios, because there's just flushes and flushes of money provided by the Fed all the time. That's what Walsh doesn't want, and and I dare say he's leaning towards doing that. Probably ends up meaning that they don't need to actually hike rates, but they just need to stop printing money, basically. So the problem with these policies is that they're stock market it's just so popular. But it's literally it's like a punk kid with their parents' credit card taking their friends out for, like, at some stage you hit a credit limit and and it gets cut off, and the US is hurtling towards 40 trillion in debt, and that's getting pretty damn close. So yeah, if you want to get a Mosaic subscription, we've got the interactive earnings calendar for July going as well. Due to really high demand. So we ran this back in late May, early June. It's an S&P 500 vol targeted index. So vol targeting just means it smooths the risk and manages the participation rate on big up and down moves, but not overly complicated, to be brutally honest. But essentially what this does is on a defined day. Last time it was Tuesday. It has an observation period until mid-November, whereby the lowest Tuesday settlement price in the S&P index is your entry price, and it's a 3-year index investment. So you effectively don't have to worry about like sitting in front of the terminal and picking levels, etc. You let the strategy do the work for you. You stop guessing when the dip's going to be. If it goes down 30%, well, you get somewhere around there. If it only goes down 15, you get somewhere around there. So it takes all the guesswork out of it. It's a really popular strategy. We had, a record amount of new clients come in on it. We're reopening it. It will be closing at the end of July, in the last week of July. And if you go to mpcinvest.co/buy the dip or scan the code, you can get involved, have a look at it. It is available to both retail and wholesale investors. So we don't run retail often, very often, only really 2 or 3 times a year maximum. So if you're retail investing, you've got S&P index ETFs, you can take some profit, go into this, you get a nice bit of leverage to the upside. It's using options and buying calls, so it's capped to the downside in terms of but importantly, you just put less in, but 100% of your capital's at risk. And go and check out Bulls versus Bears podcast, EP 126, halftime report for the full financial year report for the ASX, halftime report for all markets globally, on your favorite podcast apps, Spotify, YouTube, and Apple Podcasts. We can go to mpcmarkets.com.au/podcasts. Look, I dare say we're going to have a pretty, today on the ASX is going to be not dour, but not overly positive. You will start to see some people go, maybe some bargain, go to the bargain basements in the energy sector, and probably continue to buy those defensive sectors like the healthcare sector as well. So, good luck today, people. Make sure you have a look at those things that in your portfolio and review, because you've got to remember we haven't had a dip in a very long time, and things get panicky pretty quickly, and things with Donald Trump and Iran particularly can escalate very quickly, as we've seen. But have a great day, and we'll speak again tomorrow.